Hey everyone and welcome. Today we're taking a look at the financial blueprint of a tool that's incredibly powerful, but honestly pretty misunderstood. We're talking about whole life insurance. We're going to break down its structure, its guarantees, and see how all the pieces fit together. So let's start with this question. Just imagine for a second. What if you had a single financial tool that could be a permanent safety net for your family and, at the same time, act as your own private source of capital that you could tap into whenever you saw an opportunity? That's exactly the dual role we're digging into today.
To really get how that's even possible, we have to start at the beginning, with the foundation. Every solid blueprint starts with the core components, so let's break down what actually makes up a whole life policy. At its very heart, whole life insurance is basically the most stable and predictable form of life insurance out there. You should think of it like a permanent contract that's built on a rock-solid foundation of guarantees. The words you really want to remember here are permanent, guaranteed, and fixed. Those three things together create something really unique and stable.
And here are the four core pieces that make it all work together. You pay a fixed premium. It never changes. And that money does two jobs at once. It funds the permanent death benefit for your loved ones, and it funds the guaranteed growth of your cash value. Then, on top of all that, you have the potential for dividends, which can act like a turbocharger for your policy's growth. We'll look at that next.
Yeah, that dividend piece, that's a real engine for growth. Now, you could just take the cash, but the most powerful move is to use them to buy something called paid-up additions, or PUAs. It's kind of like you're buying these tiny, fully paid-off life insurance policies that get stapled onto your main one. Every time you do that, you boost your death benefit and you pour gasoline on your cash value growth. That's what creates this incredible compounding effect over time.
So, building on those components, we get to the policy's steel frame, a set of guarantees that are, well, unbreakable. And I'm not just saying that. This isn't some marketing promise. It's legally binding, written right into the contract.
And here's what makes that steel frame so incredibly strong. The growth of your cash value and that death benefit, they're contractually walled off from what's happening in the stock market. Recessions, crashes, crazy interest rate swings, none of that can touch the core guarantees. That stability is really what sets this whole thing apart.
And this chart just lays it out crystal clear. On the left, you have a completely predictable path. Your cash value is guaranteed to go up every single year, and it can never, ever go down because of a market crash. Then on the right, you've got typical market volatility, where, as we all know, value can disappear overnight. With whole life, you're basically trading that risky market-linked upside for absolute stability.
Okay, so we get the structure, and we know it's strong. Now for the fun part. Let's look at the floor plan. How do people actually use this thing in their day-to-day financial lives? One of the most common ways is for retirement. You can actually borrow against your own cash value, creating a stream of income for yourself. And because these are structured as loans, you're borrowing from yourself basically, the money you get isn't considered income. That means it's typically tax-free. It's a great way to supplement other retirement accounts without getting a big tax bill. It also works like your own private bank. Say you need a down payment for a great real estate deal, or maybe you need a quick cash injection for your business. You can borrow against your cash value, no credit check, no questions asked, with a super flexible repayment schedule. And the best part? The money inside your policy just keeps on compounding as if you never touched it.
And for a lot of people, this becomes the ultimate emergency fund. Think about it. It's liquid, so you can get to it fast when you need it. In many places, it's actually protected from creditors if you get sued, and all the growth is tax-deferred. So when you compare it to a regular savings account, yeah, it's a much more powerful alternative.
Of course, building a structure this strong takes investment and commitment. It's really important to have a balanced view, so let's be upfront and talk about the costs and what it really takes to make this work.
So here's the reality of it. The premiums, they're definitely higher than for simple term insurance, and that's because you're funding a permanent benefit and that cash value account. Also, the cash value growth feels pretty slow in the first few years because a lot of the policy costs are paid up front. This is not a short-term play. You have to be in it for the long haul, 10+ years, to really see the magic of the compounding kick in.
This quote just hits the nail on the head. This is a tool for people who have a long-term mindset, people who value certainty and predictable growth more than they value chasing the latest market highs. It absolutely rewards financial discipline and patience.
So, now it's time for the final inspection. We've laid out the pros, we've laid out the cons. Let's do a quick, direct comparison to help you figure out if this financial blueprint is the right fit for your specific needs.
Right. The big question. When you put it up against other kinds of life insurance, where does whole life really shine? Let's put them side by side and see.
Take a look at this table, it's pretty telling. Just look at the column for whole life. See all those yes answers for guarantees, level premiums, and lifetime coverage? Now compare that to VUL and IUL over on the right. Those are policies that tie your cash value to stock market performance. They introduce risk, they introduce complexity, and they get rid of the guarantees. Whole life, by contrast, is engineered from the ground up for simplicity and absolute predictability.
So who is this really for? Well, typically it's a great fit for people who value everything we've just talked about. We're talking about high-income earners who want to save and grow money in a tax-advantaged way. Business owners who need that flexible capital on standby. Or really, just anyone who wants to create a guaranteed legacy for their family without losing sleep over what the market is doing.
So to bring it all home, here's the final takeaway. Think of whole life as a foundational financial tool. First, it's a permanent safety net. Second, it's a predictable base for your wealth to grow, with zero risk. And third, it's a liquid reserve you can use for all sorts of things. It's really about building that solid financial foundation first before you build the rest of the house.
And that really leaves us with one last question to think about as you look at your own financial plan. Is the future you're building based mostly on predictions and hoping the market goes up? Or have you laid a foundation that's built on contractual, mathematical guarantees? Definitely something to think about.